Hi, everyone. My name is Yang Wang. Nice to see you again. Hope you all had a good summer. Today is the first session of our investing group series. The book for today is Psychology of Money. Our group usually meet on the second Tuesday evening at 7 o'clock. Today we meet on Thursday is because we don't want to schedule the first meeting right after Labor Day. I want to give you a few days to read the book. Okay, so before we start, let me give you a brief introduction of Kristen Jacks. Kristen Jacks is a financial educator and author of Money in Your 20s. Kristen worked for Kiplinger's Personal Finance magazine and the Mutual Fund magazine before becoming a writer and a speaker. Her next book, Investing Explained, will be available in October. Kristen is a graduate of Duke University. As you know, I have started recording the program. After the program, we're going to post the recording on the library's YouTube channel. Okay. So please keep muted during the session. Unmute only when you need to speak. Okay, now let me turn the screen to Kristen. Thank you, Kristen.
Thank you, Young, and thank you, Greenwich Library. Greenwich Library does an amazing job of offering all sorts of terrific programming, so you should definitely check out the calendar. I've signed up for 4 different things this coming month. It's amazing what you guys do. So welcome. This is season 2 of the investing discussion group. And Young and I worked very hard this summer. We reviewed a lot of books and boiled it down to the books that we thought, sort of the best-selling books that could help you reach your financial goals faster. And the first one tonight, Psychology of Money. It's okay if you didn't read it because it's going to be a lively discussion no matter what. But we do want to give you a preview that the next book is The Bond King, and the book after that is A Random Walk Down Wall Street. So you have plenty of time to prepare and get ready. But the whole point is really to make this second season about books that can get you to your goals faster, and to have discussions that are lively and jargon-free and relevant and informative. Okay, but before we start, since we're talking about investing and a lot of things can go wrong with investing, we have to have a disclaimer that this webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments or methods of investing, like for example, like passive investing versus active investing or day trading or things like that, none are recommended. And many are not suitable, okay, depending on who you are. So if you plan to invest, you are urged to consult an advisor who is aware of your unique situation. Okay, so the book tonight, The Psychology of Money by Morgan Housel. The subtitle is Timeless Lessons on Wealth, Greed, and Happiness. Now, who is this guy, Morgan Housel? He sold over 2 million copies. And I'm sure it's more. I mean, this is just what they say on the jacket of the book, 2 million copies. It's probably 3 million by now. Who knows? That's astounding for a nonfiction title. This is not Harry Potter. This is not the Twilight series. So who is this guy? Why did he strike such a chord? And, how could he possibly sell all these books? So I love Morgan Housel. He has a podcast that's really fun to listen to because he's such a great storyteller. He's very engaging. And my takeaways are he's a history buff. He's always telling great stories about history. He's an avid reader. What kind of gave him the credential to write the book, he was a columnist at the Wall Street Journal for a while, and then he has been a writer for years, or had been a writer for years at the Motley Fool. And if you don't know what the Motley Fool is, it's really popular among investors, just kind of talking about stocks and investing ideas and which stocks to try, which to avoid, things like that. He's currently a partner at a private equity fund. And also, I think tonight you might suspect, I certainly suspect, that he's a bit of a rebel in a good way, like an educated, thoughtful, careful rebel. So without further ado, Okay, please mute yourself if you stay muted unless you want to talk, which we hope you want to talk, because this is the investing discussion group, and we really want to be encouraging discussion. I know it's a little tricky because we're just starting out, so maybe you didn't have time to read this book. But I want to say, you know, coming up is The Bond King by Mary Childs in October, and that's all about Bill Gross. It's fascinating, Bill Gross. I mean, it's so interesting, the bond world, what things were like when Bill Gross first started out. Before he started PIMCO, you know, bonds were like in a vault, and everything was paper, and there were no computers, there were no electronics, there was no trading. I mean, the book is fascinating, just talking about how much bonds changed and what a genius Bill Gross was and what kind of a curious personality he was. So if you're at all interested in bonds, this is kind of like a must read. And then in November, we're doing a random walk down Wall Street, which really gets into so many theories about, you know, what does and doesn't work. And Malkiel, who's was a professor at Princeton. I mean, it's just very clear writing. It's very interesting. So those are coming up, and will help with the discussion if you guys have read it. And then for tonight, if you've read it, please, please, please chime in. But I'll get us started, okay? So I just took a scan of the table of contents. And what's easy about The Psychology of Money is that it's not a continuing like narrative, right? So he even admits, Morgan Housel admits that he's basically doing a lot of short stories almost, and kind of quick ideas. And you don't even have to go in a certain sequence to appreciate the book, really much beyond just kind of the introduction. So I was going to start in the middle, because the more you get to know Morgan Housel and his appeal, you find that his definition of winning with money is all about freedom. And it's really interesting. I'm going to jump ahead and then I'll jump back. I just want to talk about this stark contrast, because especially in researching my second book, which is coming out in October, Investing Explained, it's really a basic primer for people who don't want to hear all the jargon, weren't taught, you know, stock investing at home and things like that. I have read so many books to prepare for writing my book, and it's really interesting how you have sort of these power-focused, energetic entrepreneurs, like you have all of these people out there, like a Bloomberg or a Phil Knight or a Steve Schwarzman, who started Blackstone, where they don't mind working all the time. I mean, I think they would be uncomfortable being home. I mean, they are so intense, and for them, money is about power, and that power is, you know, not just like building something and kind of controlling it and bringing something to life, but also having access to interesting people and having influence. And you know, whether it's Phil Knight, who wants to be able to, you know, have dinner with Young, can you figure out, like, can you figure out who we need to mute? Young?
Okay, I'll mute.
Okay, thanks so much. Anyway, there was really this stark contrast with all these books I've been reading about the people who, you know, make a lot of money, were very entrepreneurial, and they wanted access and they wanted influence. And for them, money is like, you know, if you're winning with money, you've really increased your power. And Morgan Housel is the opposite, and also echoing, you know, a previous bestseller, Your Money or Your Life, started, it was copyright 1992, but it's been a multi-year bestseller. I mean, it always comes back, and it's sort of this theme of like, you know, don't be so caught up in material things. Don't be so caught up in other people's impressions of you. You know, maybe manage your money in a way where you can just sleep at night. You don't have to work. If you've been very frugal and very careful after 20 odd years, maybe you could just live on the income and just do like the passion projects that you like. It's a very, very different message. Of the whole point of being good with money is to gain your freedom. And if you've heard about the FIRE movement, the financial independence, retire early movement, this is all part of that same message. I mean, there's so many people out there where they're working hard, they're accumulating savings, and they're being very frugal because to them, the ultimate payoff is to not have to do those things anymore. And which is the opposite of what other people are saying. So Morgan Housel says that he actually, when he was in college, he wanted to go into investment banking, and he got an investment banking job for the summer, and he lasted 1 month. And he said he couldn't believe how bad it was. He couldn't believe how long the hours were, how you had to work every weekend, how other people just kind of came at you. You had no control. And even though he loved the idea of the work and the projects, it was just like too long. And he just said doing something you love on a schedule you can't control can feel the same as doing something you hate. And I think a lot of people have had this experience, right? If you work at a top law firm, do they let you go home? Not at first. I don't think so. If you go into medicine and you want to be a resident, I mean, it's just sort of like, they have all these TV shows about these people who are on 20 hours of no sleep and then make the medical mistake and things like that. So it's this very interesting idea of like, just, like, you might love the work or the idea of the work, but it's too much. And what being good with money helps you do is control your time. Okay, so again, this was like the stark contrast. And I think that it just kind of pervades the book, how he just wants you to ignore that message of like going for power. Okay, so anyway, the theme of this season of the Investing Discussion Group is the best-selling books that will help you reach your financial goals faster. And this is a no judgment zone. So you have to decide for yourself, are you going for power? I mean, I admire so many people who really, they kill it in business because, maybe they do want to be the mayor or, a senator or something like that, or they at least want to influence others, and they know that their success is giving them that influence. So no judgment, but if your idea of doing well with money is the power route, then this book, parts of this book are definitely not for you. Okay, but I really, really love to encourage discussion. So this, there were so many gems in this book, and I would love anyone who's read it, anyone who wants to start out, looking, here's the table of contents. If there was a particular chapter that you loved, or you hated. I mean, was there anything that really jumped out at you about Morgan Housel, the psychology of money? What is his message? Feel free to unmute, jump in. Anyone? Monica, Catherine, any of you out there? All right. Well, I'm going to keep prompting. I'm going to keep rolling ahead, but we'd love for you to participate. So I really loved this idea of, be reasonable, not rational with money. It really echoes kind of what's going on, like when economists are arguing with each other, like, economic theory underpins investing, but what if that economic theory is incorrect because it's too rational? So Morgan Housel says, you're not a spreadsheet. You're a person, a screwed up, emotional person, right? So whatever you've been told about like how to navigate money, even something as basic as like, should you be in stocks or bonds or how to save or things like that, there are times in your life you're just not going to do that, right? Like, I mean, the classic is like when, if you're married and you're pregnant, like whatever is normal is going to go out the window, and the nesting instinct is going to screw up all of your savings and things like that. So I love that Morgan Housel is talking about this, and just give yourself room for what might even be considered irrational behavior. And behind that, he has a real love of kind of these Nobel laureates. So all of these guys have won a Nobel Prize, 2 in economics, 1 in psychology, but they've really been focusing on decision making, and some of it, more Daniel Kahneman is just being extrapolated around money, but Bob Schiller at Yale and Dick Thaler at UChicago, I mean, they've really looked at behavior around money, and that it is not rational, right? I mean, we have all these different biases. One problem is overconfidence that has been very well documented, that people overestimate their abilities. So if they're picking individual stocks, they'll probably mess up. They'll probably think that they have a better sense than the average person in the market of what's a good buy. There's a home country bias, right? So there are all of these investments out there. It's a big, big world. But what happens over and over again is that people choose the investments in the country they live in, and that's not really rational. That's actually probably not effective. The United States is a really thriving market. And there have certainly been big investors who don't stray much beyond the United States. But if you're living in, a smaller country somewhere else, and you're not even considering the United States, that's kind of a huge error. So just the emotional side, I thought he explained it very well with, you've got to do the things that help you sleep at night. You've got to realize that you're being triggered all the time by money. And you want to look good, you want to be admired by other people. You have all of these kind of secret goals that you have to work into how to handle your money. And that a normal, rational economist is going to say you're just maximizing, it's just utility, it's usefulness. And these other economists, and behavioral finance is kind of a much newer phenomenon, and finally getting the respect it deserves, is really talking about the emotional side of people and how they don't just maximize, and they're not just rational. And I think Housel does a really good job of talking about that. And just so you know, Dick Thaler, so he's one of our Nobel laureates, he wrote the book Misbehaving, all about sort of behavior, sort of the birthing of behavioral finance. And we're going to cover that book. That's actually our last book this year. So this has been very, very well thought out and planned, with Young really taking charge and wanting every book picked out for the whole season. So we've planned it all the way through June. And actually, I do want to mention, just so you have a heads up. So we have The Psychology of Money now. We have The Bond King is October 10th. We have A Random Walk Down Wall Street is November 14th. All of these are already on the calendar. And if you click on the calendar and you reserve a spot, then you'll get reminders. So it might be a good idea for you to visit the calendar. If you have any problem with the calendar, what I find is, you go to the homepage of the library, you go to the homepage, and then if you look down a little bit, it'll say visit. And some people don't really know that's kind of a smart way to get to the calendar. But you go to the homepage, go to visit, you get to the calendar, and then in the search bar of the calendar, just put a new month. So you want to see what's coming up in October, put in October, and then press search. And then that's how you kind of scroll through all the different opportunities. So we have A Random Walk Down Wall Street in November. In December is How to Invest in Real Estate. January is Celebrating Startups. And that was a really fun one to put together, because read Shoe Dog by Phil Knight and That Will Never Work, which is about the founding of Netflix. But it's really just talking about startups in general and trying to make money. Because a small business can be a really smart investment, either if you invest in someone else's small business, if you have that opportunity, or starting your own. In February, we're doing The Price You Pay for College, which is Ron Lieber's book. Ron Lieber is the Your Money columnist for the New York Times, and his book is really fascinating. He did some incredible research, especially about merit aid, which a lot of people, it's not a transparent area of financing college. It's basically colleges discounting, giving huge discounts off of tuition, and kind of learning who qualifies for that and how that works. And it's not financial aid oriented. So that's going to be really great. That's February. March is the Bible of Investing, which is called Margin of Safety. So that's going to be super fun. April is The Quants, which is all about quantitative, more and more people taking over Wall Street. They're not hiring MBAs out of school. They're hiring PhDs in math and science that can build algorithms that can kind of try to jump in and make investments or react to the market under certain circumstances. Fascinating. And then in May is ETFs for dummies, so exchange traded funds. And in June is Misbehaving, getting back to the behavioral finance. So we hope you'll take some time to sign up and look at those. Okay, so again, anyone jump in at any time. I know this is tricky because a lot of people did not have time to read the book, but it's really a fascinating, fascinating book with, and again, you don't have to go in any kind of sequence because probably because Morgan Housel was a writer at the Motley Fool and the Wall Street Journal, he has all sort of these topics that he covered, and then he can just put them all together in a book. So if anybody wants to unmute.
I have a question if you don't mind.
Yeah.
So I was wondering, do you think this book would be good in terms of bridging the gap between generations when it comes to talking about money? I feel like I hear a lot of conversations of parents being distraught about how their children spend money and children saying that their parents don't understand the economy that they're currently growing up in.
Well, what's interesting is that he talks about how there is this gap between, it doesn't even have to be parent and child. It could be, with your spouse or with your coworker. For one, he starts out with "no one is crazy." I think that's the one I'm going to next, where people have had such different experiences around money that they can feel very passionately about their point of view, and another person can have a very different point of view and be very passionate, and neither one is wrong and no one is crazy. And so one thing he means by that is, for example, some people love the stock market and some people fear the stock market. Some people want to be heavily invested in stocks. Other people think it's too risky. And he gives this example of, if you take any 10-year period, so these are, what this chart is showing is in a 10-year period or any length of time, right? There are 1-year periods, 3-year periods, 5-year periods. In the entire history of the modern stock market, what was the best 1-year return and what was the worst? What was the best 3-year return and what was the worst? What was the best 5-year return and what was the worst? And when you look at the 10-year, it's amazing. If you think about someone taking the time to be very careful with their money and trusting the stock market, putting their money in the stock market, well, over a 10-year period, there have been people who were rewarded, right? They're almost at a 20% annual return. So that their money has more than doubled, right? It only it would double in 7 years at that kind of pace. Or no, more. I mean, certainly more. But then another group of people getting in at a certain time, like the year 2000 was a terrible time to get into the stock market. They either, the people who got into the stock market in the year 2000, they're like the lost decade, right? So they could have been carefully saving year after year and they had nothing to show for it after 10 years. And that can be so frustrating and disappointing, and it just marks you forever. And Morgan Housel talks about that people who grew up in the 50s have a very different view of people who grew up in the 70s, because the market in the 90s was roaring. So if you were born in the 70s, then as a teenager, young adult, you saw stocks just take off and you thought, well, this is always worth doing. Maybe you have to be careful of crashes and things like that. But basically, in the end, stocks always go up. And people who were born in the 50s who dealt with the market in the 70s did not have that experience at all. Their money went sideways. The market was not a good place to be. And back then, fees were astronomical. So even to get into a mutual fund, you might pay an 8% commission. So not only did you not make any money, but you paid so much in fees, you just felt like a fool. So he really tries to talk about how when you're disagreeing with someone, it's probably based on their experience. And you have to kind of respect those experiences. And he also talks about, if you want to talk about parents and kids, sort of this idea of like, I think what you're saying is that, a lot of parents can't understand because they maybe went into a better job market. The people who got, certainly much older people were dealing with like an America that was so, it was growing and there were so many opportunities and rents were so much lower and all these things. And then young kids today in this area, it's like they can't possibly live as well as their parents. They can't afford anything. And they've lived through the financial crash and all these different things. So, so those are some, again, generational differences that he talks about in pretty much No One is Crazy is a great, so that particular chapter, No One's Crazy, he gives lots and lots of examples of what different people have experienced and then why they would then say, well, this is my experience and that's it. And not only that, but that 401k investing or sort of being in charge of your retirement in general is a relatively new concept. I mean, people weren't living that long. There were pensions. So, take it easy on yourself if you're a little nervous. Okay. So, man in the car paradox, or what I like to say is what your teenager will never believe. In this chapter, he's talking about how no one is impressed with your possessions as much as you are. And this is a real theme with him. Again, we're getting back to Morgan Housel thinks, be frugal, save. And the point of doing all of that is to have this amazing freedom, to not be dominated by anyone, to not have to do work that you don't like. And maybe because of all of that, he's also convinced himself that, no one's impressed with these material possessions. And I really struggle with this, especially, we're all in Greenwich and this is a town that's kind of made for nice cars, big homes. Is everyone just kind of spending money that they don't need to spend because nobody cares about these impressions? Morgan Housel actually is relatively young and his oldest child is 7.5. So I'm going to be really curious a decade from now how he's doing, if he's been able to hold his kids at bay who are like, Mom, Dad, we need to have a better car. We need to have a better house. I mean, a lot of the times that I hear those messages in my home, it's because I have a 19-year-old and a 15-year-old. And it's just like, I think young people are very impressed with different things. So he's saying that no one is impressed. And I'm not so sure. But certainly people are not thinking about you as much as you think they are. Like that's kind of the classic teenage issue, is that they are so self-conscious and they think everybody's watching them. And in fact, they're just thinking about themselves. Okay, and then another really interesting chapter that kind of relates, the Never Enough chapter, is pretty much the Bernie Madoffs of the world and the people like him, didn't get this memo of you don't have to show off, no one's impressed. Because, and the Never Enough chapter is fascinating. It really talks about how Bernie Madoff was actually a legitimate businessman. He was legitimate and he was very successful. And he certainly could have had a $5 million house in Greenwich and the private club memberships and the nice cars and all of those things. But he actually became a criminal because it wasn't enough for him. So he had a good reputation. He was, he really, I want to say that there's a part of the book where they talk about his credentials and that he had a pretty impressive stature within the NASDAQ. And I'd have to go back and look at it, but like he was really respected in his industry. He had a thriving business. Bernie Madoff was respected in his industry and he had plenty of money and it wasn't enough. So this whole idea, and this is why Morgan Housel is talking about timeless stories of greed, is that one factor in greed is some kind of need that you have to be larger than life, or you have to outdo other people, or if you don't join the billionaire club, if you're not rubbing elbows with Jeff Bezos, then somehow I just can't even imagine that kind of hunger, but he talks about it. So for himself, Morgan Housel's like, I don't need any of those things. I definitely have a sense of enough. But there are just so many examples of people actually, using fraud because they have to fuel their ambition. Okay, so I'm just going in the order that I like, because this book was fascinating and there's so much in it. And like I said, you can jump around. You don't have to read it in sequence because it doesn't build that way. But he has a chapter on, taking advice from other people when it comes to money, and that you have to be aware that you don't want to take financial advice from people who are playing a very different game. And this is absolutely true. There is a suitability standard in finance where it's really important. I mean, and this is not true, like, of your broker down the street. He doesn't have to give you really, really good advice. He doesn't have the fiduciary standard. He's supposed to have the suitability standard, but a suitability standard is like, you realize what that other person is capable of, comfortable with, trying to accomplish, their risk tolerance. And, for example, like I day trade, but I day trade because I've been studying the market for over 20 years. I worked at Personal Finance magazines. I was there when they invented, when the E-Trades of the world first came into being. I'm very comfortable around, looking at stocks on my phone and buying them and seeing opportunities and things like that. And I day trade not because I'm a huge risk taker or very speculative, but sometimes out of nowhere, the market will just suddenly have a sale, right? It'll just be on sale. And some stocks that I like, just all of a sudden they're down 5 or 6%. I buy them. I can never give somebody else advice because I know I'm going to sell those stocks when they rebound. I'm just looking for certain opportunities, quick hits, just because I know how to do it. But it would be terrible for me to turn around and say, oh, Nordstrom's, really gotten hammered recently. Or if somebody just watched what I was doing and said, oh, wow, she bought Nordstrom. It sounds like it's a good investment. I'm going to buy it. And that person's going to buy and hold. And I'm like, I have no idea where Nordstrom's going to be 2 years from now. All I know is that it's selling at a discount right now to where I think it is. I think other people are going to bid it back up. And, I'm in and out in a week. So that whole idea of being really careful and never mimic what other people are doing because you don't understand, are they investing for the long haul? Are they day trading? What are their goals? What's their comfort level? Now, just a terrific, terrific chapter. Okay. Another terrific chapter. You don't need a reason to save. This is a guy who really wants his money to create freedom. So he's definitely very frugal, living well under his means. I mean, now, after selling over 2 million copies of his book, he's living really well under his means. But even as he wrote this book, not knowing that it was going to be a huge success and being only a journalist, he was being very careful with money. And he says he and his wife are in agreement, and they bought a house below their means, and they're raising their kids below their means, and all these things. And his really big piece of advice is that you don't have to get caught up in goals. Don't save because you're saving for a house. Don't save because you're saving for retirement. Just make sure you are always, always saving so that you're in that habit of always living below your means. And that's the real trick. And also, if you just think you should always have a lot of money saved, then you're not just going to spend it. You're just building and building and building a big nest egg. So that was a big part of his advice. Tails, you win. There are different parts of this book where I think he's just trying to reassure the average reader that a lot can go wrong and you're still going to win, because a lot does go wrong. I mean, the financial crisis, stocks lost 50%. And in the worst time, stocks were down 50%. People, I mean, how does anyone get through that and then still trust that things are going to work out? And so in that chapter, he gives many, many examples of how things can go wrong, and they will go wrong, and you're still going to come out ahead if you stick with your plan. And he actually talks about one of my favorite people, Peter Lynch. one of the best investors of all time, ran the Magellan Fund at Fidelity, kind of has that classic, I don't know if you can see here, the classic white hair. Even though when he was really young, he always had the classic white hair. He's great on YouTube. If you ever just want to listen about great investing stories, you can go on YouTube and search Peter Lynch, probably search Peter Lynch investing, because there might be other Peter Lynches. But Peter Lynch would talk about how Peter Lynch is considered one of the best investors of all time. And he said he only had to get 6 investments out of 10 right to do really well to make a lot of money. And guaranteed he was letting his good ones run, instead of like selling those when they finally do well or holding on to his losers or whatever. He had strategies around that. But the Tails You Win chapter is talking about giving so many examples of things that can go wrong and you're still going to be ahead, and things that have gone wrong and people have still ended up ahead. So there's a book called A History of the Market in 5 Crashes. And it's a great book by Scott Nations. And, I've read about all the crashes, and guess what? There have been 5 big stock market crashes, enormous stock market crashes. And at the end of the day, if you kept your head and you didn't buy high and then sell low in a panic, you're fine. You're fine. So that's just a reassuring chapter. Morgan Housel is a history buff. And I think one of the reasons he's a history buff is that he's clearly really into control, because he wants to control, like, his use of money is freedom, and he doesn't like people telling him what to do. He doesn't like to be locked in, office buildings all weekend as an investment banker. He hated that. And he really loves to read history, and he recommends to other people to read history. And so this chapter, Surprise, kind of an unusual title, because there's like, what's the surprise? But what he wants to convey is that history, you should read history. If you care about investing, you should read history, because history teaches us to expect the unexpected. So read history so that you are flexible, and so that you don't back yourself into any kind of corner where you can't have things go wrong. But also don't read history as predictive of the future. So he says all the time that people use history the wrong way. And he's not the only one. There's this guy, Jamie Catherwood, who's really interesting. He's a sort of a financial historian. And he says all the time, people use history as like a roadmap of the future, when, it's a compass at best. So you're encouraged to study history, but with the idea that it'll just help you be ready for like the weird things, like, a pandemic that nobody saw coming. Okay, I have a thought question. Okay, so we've spent a lot of time on Morgan Housel here. We know that he has the attitude that the purpose of money is freedom. We know that he's really frugal. We know that he doesn't think people are impressed with material things. He doesn't care about having a fancy car. And he says that our attitudes about money are coming from our experience, right? So the people who experienced, a stretch of 10 bad years in the stock market, that was their experience. So now they don't trust the stock market, versus the people who saw, their money double in a short period of time, love the stock market. So if he's saying that, your attitudes come from your experience, and he has these certain attitudes, like, what do you think his experience was? Like, who is this guy? Would you say, do you think he grew up poor? Do you think he grew up rich? Do you think he grew up insecure? Do you think he is insecure? Do you think he's secure? What do you think? Anybody? I'll tell you what I think. I think Morgan Housel is an extremely secure person. I think he did not grow up with any shame around money when he was younger, where his peer group had a lot of money and he didn't. Because I talked to a lot of people over the years. I have just one of those faces where people end up telling me their story. And a lot of people that really, really care about the big house and the private clubs and the nice cars and the prestigious job and the things like that. You know, they have something in their past where they felt embarrassed, or they felt one down, or they felt like the poorest kid in the neighborhood. And maybe they were, you know, one of the poorest in the neighborhood. So I'm just going to check one thing because there's something in the chat. Hold on one second. Oh, learn from mistakes. Yeah, good one. Good one. I like that, Karen. So I would say that I would guess that Morgan Housel grew up not rich, but not poor, comfortable and secure, or maybe he just has kind of a naturally secure personality, feeling very happy and content, seems to be able to be very content. He wrote this book before it sold 2 million copies, and this was his advice. So he didn't know he was going to have a windfall on his hands. And it really seemed, you know, everything he was saying really, really seemed to resonate because I guess you sold 2 million copies because somebody reads it and then they recommend it to like all their friends. You know, this was not a highly advertised book, and his is not a super connected guy. He really was a nobody until he wrote this book. So I would say that I would think his experience is that he felt comfortable and accepted growing up, and he says his wife feels the same way. So he's lucky enough to find someone who is also not very materialistic and probably is feeling very secure. So yeah, that would be my guess on him. And I do recommend his podcast. He's a great storyteller. And I always learn something when I listen to his podcasts. And so you can find his podcast but you go into any podcast app that you like and search Morgan Housel and it'll pop right up. But anyway, so let's go back to some chapters. Let's do anyone can jump in at any time, talk about a chapter that meant a lot to them. You know, the wealth is what you don't see is kind of along these same lines. He's a really, really non-materialistic guy. And I think he is trying to convince other people. I mean, certainly get this book for, you know, if you're a parent and you're worried that your adult child is too materialistic, this could be very helpful for them to consider that other people are not that impressed, or it's not a goal in and of itself. And then some of it is just, you know, it's just super, super practical. So the confounding compounding chapter is talking about at the end of the day, to really take advantage, to really jump ahead with your savings, to, you know, that you need to save for years. And then it's at the tail end that the compounding, you know, the compound interest kicks in and does this phenomenal stuff. And he talks about how Warren Buffett, you know, I mean, Warren Buffett was wealthy and doing well and things like that, but the phenomenal wealth that he has right now is really due to like the last 10 years of the compounding on all of his investments. So yeah, some of the chapters are just super practical. You know, getting wealthy versus staying wealthy. I don't know how many people need to read that right now. You know? Are you wealthy and you're just, woo, solved that problem. Now I'm just going to figure out how to protect my wealth. But this is a thoughtful guy, and he reads history, and he's just trying to give good advice to whoever needs it. And he really talks about how you build wealth is very different than how you protect wealth, and how you, you know, when you're building wealth, you're taking risks and you're being very energetic. And when you're trying to stay wealthy, you need to be like slow moving and paranoid, basically. So lots of interesting things going on in this book. And anybody else want to join in? Hopefully, we will have more time in October for everyone to read the book, The Bond King, and really like develop an opinion about it. And you know, we really would love for this to be a lively discussion. And let's see. Okay, so no one's crazy. Luck and Risk. Didn't love that chapter. Hold, let me just look in the chat. Oh, does chapter 4 discuss the rule of 72? Oh gosh, what's that rule of 72 again? It has something to do with like if you reach a certain level of interest, then things double quickly. So Kevin, can you, if you remember it, would you just type it into the chat? Like, so when things are compounding, the rule of 72 is something like, if you make 7%, it doubles in 10 years. If you make 10%, it doubles in 7 years. Is that the one that you're talking about? It probably does. I mean, he really gets into the kind of the technical of like, you know, how your money grows, you know, once you have a good base of it over a number of years. Good question. All right. What else? He actually has a chapter that you can't see here because it's chapter 17. It's bled over to the other page, where he talks about one real problem with financial writers and media in general is that pessimism sells. Scary things sell. You know, the market's going to crash, the world's going to come to an end, that sells. And he really talks about how you have to just kind of remove yourself from all the pessimism and not get triggered by it. I'm just going to look in this chat to see if the rule of 72. What did we get? The rule of 72 is a quick, useful formula that is popularly used to estimate the number of years required to double the invested money at a given annual rate of return. Alternately, it can compute the annual rate of compound return from an investment given how many years it will take to double the investment. Okay, right. I don't remember if he specifically did that, but he certainly gives very, very good examples of, you know, of how the compounding, it's really kind of the tail end that the compounding can give you these extraordinary gains after you've made a good pile of money, and it takes years. Anyway, so talking about the chapter 17, which was all about sort of avoiding the pessimism. And this is a guy who worked at the Wall Street Journal and worked at the Motley Fool. And there is this sort of this clickbait aspect of financial writing now, where people are much more drawn to scary things and catastrophes than they are to sort of the slow, plodding accumulation of money, which is just kind of a boring story. But if you're always, you know, if these financial outlets are always writing about the scary stuff, they can kind of scare you away. And he's like, don't get scared away. A lot of that stuff is just clickbait. So he calls it the seduction of pessimism, and how the financial media is using it, and how you might get triggered by it, but you know, stay the course, have good habits, be frugal, live under your means, always save, and you know, don't worry about, like, you know, if the market crashes, don't sell. Just hold tight. All right, well, I think you guys have the gist of the book, and let's see. Yep, we covered that, and we covered that. And if anyone, you know, wants to jump in, just unmute to say what you enjoyed or what you liked. Otherwise, I think we should just focus on the books that are coming up. I hope you will go on the calendar and sign up for the October 10th, The Bond King, all about Bill Gross, all about how the bond world changed so much. It went from this sleepy, all paper, super boring, you know, bonds or loans, you get some interest, to a really fast-paced, fascinating world. We'll even throw in Mike Milken. I'm, you know, just to let you know, I'm a huge Mike Milken fan. I think he was a genius. He was such a geeky guy. If you really got to know his work, he was not flashy. He was not fraudulent. He was kind of this super geek who really opened up the bond world. So if you're at all interested in bonds, then definitely read The Bond King and sign up for the discussion October 10th. Hopefully this chat is not someone telling me I'm completely wrong about Mike Milken. Just heard about this yesterday. No time to read. Thank you for a very interesting lecture. Oh, you're welcome. Yeah. So I think that's what's going on with this first book. We had to get this launched. We had to get this rolling. So I know a lot of you guys didn't get a chance to read this book. Totally recommend The Psychology of Money, and really looking forward to promoting the upcoming books so that everyone has time to read The Bond King for October, A Random Walk Down Wall Street in November, How to Invest in Real Estate in December. Oh, and thank you so much. Oh, that's so nice. Thank you. Thank you. This is great. If you have any questions, here, this is my email is kjacks. I'm Kristen Jacks, kjacks@moneyinyour20s.com. If you want, to be reminded about when these, what the books are, what the dates are. If you want help signing up, you can either email me or you can email Young Wong at Greenwich Library. And Young, can you put your email in the chat? I mean, I know it's
yes.
yeah.
We still have some time, so I can go. If you finish your lecture, I can, go over how to register. You said that some people have difficulty finding.
Oh, that would be great.
Online. Okay.
Yeah, and definitely put your email in the chat too, because you can help people register for the upcoming ones.
Sure. Give me. Don't leave. I have something to say about the books. Okay. Hold on. Let me share screen.
Yeah. Do I have to unshare for you to share?
Yeah. You unshare.
How do I do? How do I unshare? I don't know. Are you able?
Yeah, give me 1 second. I can share. Give me 1 second. Yeah, do you want to continue? Yes, I want to continue. Okay, can you see the screen?
So I can see this is the website for the library, right?
Yeah, this is. I'm going to share how to register. People say you just mentioned some people have difficulty.
I think it'd be great if you just show them, if they're on the home page of the.
You're on the home page, you go to visit under calendar. Here you can click dates. You can find.
See, that was the part that I think might be confusing to people.
You cannot see the previous program, but you can see the future program. So you can go to October, and then here in the category, you choose business, career, and the finance. Click here. And
but even if you don't choose business career, even if you just leave everything blank,
you choose all the programs as by the library. But if you're only talking about the business program, you just choose the category, choose business, career, and the finance. You click search. They will list you all the business programs. So the next one for our discussion group is here, October 10th, the Bond King, 7 p.m. You click on that. It will click here to register for registration. You can sign up for more than one person at a time. Our registration usually starts 3 weeks before the program date. And the closing date is when the program started, registration is closed. So here you can see what's going on for November, but you cannot sign up for November's program because we only open registration 3 weeks in advance.
Oh, really?
It's November. Yeah.
If they clicked on November, it wouldn't let them sign up?
Yeah, it won't. See here? Oh, it let you register already?
It let me register for the October one. That's why I'm saying.
Okay. Yeah, this one allow you to register. Let me try December. Oh, it does. I probably did not put
which is good, because then if they go ahead and register now, then they'll just get the reminder. So that way they
get the reminder. Yeah, because once you register, the system will automatically send you a link, a Zoom link. And also the day before the program, the system will send you a reminder email. And also when you register here, see this business and the career email list. If you click here and put your name information here and then click on the topics you're interested, so automatically every month the system will send you our program list, like our press release, a list of the business. If you choose your interest in business programs or business career and you're interested in the health wellness program, we will send you every beginning of the month, we'll send you a list of programs on this topic during this month. So you don't have, then you know what to sign up, what not to sign up.
Yeah, that's great. It's really good to have that email and just get a lot of reminders.
To put it here. And any other questions about the program? And for this, right now in the fall, we have 2 series of financial programs. We have the investing group. We also have this series, retirement planning series. We started yesterday. Yesterday it's here. We have this. We have this series going on at the same time. Yesterday's program. Oh, see, you cannot see yesterday's program, but you can see October. October, we're going to have retirement planning series, introduction of retirement option, and we have it twice a month. It's a 5-session series by Julie Jason. She owns a investment boutique in Greenwich. And she also writes for the business column for Greenwich Time for many, many years. She's a lawyer and also a fund manager. She's very, very talented, like Kristen. Yes.
And if anybody has any questions, so Young put her email in the chat. It's so it's Young Wong, and it's YWANG at greenwichlibrary.org. And so she can always help you offline to sign up, to make sure you get the alerts and things like that.
Yeah, and for the books, all the books for the discussion group, we have it in print. You can check our library catalog. We have it in print. For this book, Psychology of Money, we have it in print. We have it in our Libby by Overdrive in the digital library. We also have it in the audiobook in the digital library. That's called the Libby. So if anyone doesn't have Libby, I can show you how to get it quickly. You go to the library homepage, go to Explore under, under Visit, under Digital Library. I'm sorry, it's under Digital Library. Here, under Explore, under Digital Library, you will have ebooks. So this Libby by Overdrive, you have ebooks, you have audiobooks, you have magazines on this. The Greenwich Library card number is, you need the Greenwich Library card number to create your account, and your 4-digit PIN. You need your card number and the 4-digit PIN. If you forgot about your PIN, you can always call the library and we can set a new PIN for you by the phone. If you don't know how to use it, you can send me an email. You can come to the library. We can show you at any time. Very easy to use.
That's perfect.
So any other questions?
And you said the library bought a lot of extra copies of the books that are in the investing discussion group, right?
Yes, we do. For Psychology of Money, we have at least 4 copies plus e-copies.
And then for the Bond King, you have extra copies too. So
yeah. See here, for the Psychology of Money, we have print, we have downloadable audiobooks, we have ebooks. And then we might have.
Does it tell you how many are available in print?
Here, let me see here. So this one, we have so many copies. Main library has 2 copies. Oh, we have 7 copies. 7
Oh,
print.
gotcha.
We also have
2 of the 7 are available.
We have 2 copies available, 2 print copy available, and then we have multiple copy in ebook and multiple copy in audiobook.
And what about the Bond King? You have the Bond King?
Okay, let me search the Bond King here.
Looks like they're available.
Yeah. See, we have 5
good.
copies available, 3 copies checkout. We have 8 print copy.
Oh,
We have
perfect.
8 print, 5 there available. We also, I think we also have it on ebooks. Yeah, we have download audiobooks, we have ebooks. So audiobooks, you can connect your car on the car drive to, you know, listen when you drive. And the ebook too.
That's great.
So this, we have more than 10 copies, electronic and print. At least I would say 14 copies. I'm not sure about how many electronic copies, but at least 2 for each format, at least.
Perfect.
Okay, I think we have 1 chat. Oh, it says thank you. Okay.
All right, that's great. Looking forward to the next book.
Okay. Thank you, Kristen. Thank you, everyone, for coming today.
Thanks, Young.
Thank you.
Have a great night.
Good night, everyone. Bye-bye.
Thank you. Appreciate it.
Thank you. Bye.
Bye-bye.